Well, hello and welcome everyone to the inaugural live stream of engineering and investment. I am your host Austin. Today we're going to go over some of the tools I use to analyze some equities, individual stocks, and some of the things I look for to pick stocks individually. So with that being said, let's get started. So this is the tool I like to use is FAST Graphs. So FAST Graphs is the fundamental analyzer software or something like that, and I've used this for a while, and it's helped me pick some of the best stocks for investing that I've invested in. So I just kind of want to start by giving a little look around and introduce the basic premise of this app and maybe a few of the other tools I use to go over how I pick stocks. With that being said, let's jump right into it. So one of the companies that I think demonstrates the premise that I'm talking about is this is called Enterprise Products Limited Partnership. So this is actually a limited partnership, not just a stock. So it has some special things about it. But to get started, I wanted to talk about what we're looking at when we see this graph. We got this black line here, which is the share price, and it's tracking the price to earnings ratio as well. And then this orange line is the fair value line, which is generally going to use a PE of 15 for stocks that are growing at less than or equal to 15% per year, and then it'll be equal to the growth rate for anything growing at a faster rate than that. And then this blue line is the average PE that it typically trades at. So when I'm looking at an investment and I want to understand if something's fair value, I want to compare where this black line is compared to this orange line. So here with Enterprise, we can see that the black line is listed as currently trading less than the orange line. With that being said, that means this stock, at least from the first glance of this, is looks like it could be undervalued. So if we click here and then we drag it out to what the projections are, we can see that it gives us a lot of metrics to look at and what we could be looking at if we invested here, and it follows the analyst projections and makes it to a fair value line, makes it back to the 15 PE. So we could be looking at total annual return year over year of 19%, and 9.42% of that would be from earnings. That means the other parts would be from dividends and the multiple expanding. I'll show you an example of a stock where stocks do rebound back to full value. So British Tobacco is one of the stocks that I want to point out that so we can use this scroller bar to go back in time. So let's just go back to 2025, 1 year. If we would have been looking at this, we can see that the share price is trading far below what the fair value line is. And we can see that historically British Tobacco hasn't traded, it's always traded at a discount to what the 15 PE is. At least that's what the average says. So here we got, so if we look at this, and we're coming out of COVID and everyone's worried about smoking, so the price really dips down to, we buy this in October 2021 because the PE is super low. Everyone's worried about smoking, but we see that the earnings are very much underneath the blue line, and we see that if we held it on to today, we get a reversion to the mean, and we're actually making 17.45% year over year. So that's a pretty good example of a stock where we get a reversion to the mean, and an example of how this tool is useful. I mean, you could have bought it even lower back in March of 2024, and you would have got a even faster bounce back, and you would have been looking at 52% year over year. That's just because it's a shorter holding window. So with that being said, maybe we can look at some of the other tools that this has to offer, because this is just a historical looking thing. So we're going to slide our scroller back to present day. This light shaded stuff is based on what the analysts are projecting. So we can go up here to forecasting. I think this is the other tab that's useful here, and we can see if we go to, well, let's see, we can go to normal multiple, and this, I like to use a variety, so like 10-year multiple gives a better idea of what the normal PE generally is for this. And so we see at current prices, it's more in line with what the fair value of this is. So if we hover over this point, we're going to see that we're really only going to get, as long as it keeps trading at this around what its average PE is. If we bought it at today's current levels, we're not really going to see much growth. We'll see like 6% per year, which if we're picking individual equities and exposing ourselves to risk, that kind of risk, not just buying the index, we probably want to get a little bit more return on our money than that. So I guess the goal with the live stream here is I hope that from chat and things like that we can take chat suggestions. I'll have stocks that I want to look at as an agenda going into each live stream. I hope to do this weekly. I'll have some stocks lined up that I want to look at, and hopefully give you guys some good investing ideas. You guys can give me some good investing ideas, and I'll put them through the different tools that I use, because some people, they're always asking me, what do you think of this stock? What do you think of that stock? And the first thing I always do is I come and I put the ticker into this tool and get a cursory glance of what does the price to the earnings value look like. So if we scroll down on this forecasting page, we see premium feature. I don't pay for the full subscription, I just get the cheap version, but it does okay for me. So we can see that this is where I was going to go next, is the analyst scorecard. And what I wanted to check out was, how good are the analysts at predicting what this stock is going to do? Because that's a big key factor in understanding how good is our forecasting. Because these numbers here, these are the analyst estimates for what the earnings are going to be. So everything out here is based on what these analysts are going to estimate. So we got 14 analysts, 11 analysts, 11 analysts, 10 analysts. Let's see how good they typically are at predicting British tobacco. So we can see here that British tobacco almost always, I mean 75% of the time, beats with 0% margin of error. And if you give the analyst 10% margin of error, British tobacco hits or beats 91% of the time. And that's 1 year forward. And this is 2 years forward, they hit 91% of the time. That makes sense if we think about it. It's smoking, it's tobacco, it's an addictive product. How hard could it really be to predict, right? So they got their spreadsheets dialed in. Not many surprises with this. So that's how, when we go back to forecasting, that's how we can see that that's why we can trust, using these numbers and looking at return. Some smaller companies or more erratic kind of revenue companies or newer companies that don't have a long history of being public, the analysts aren't as good at predicting. So let's take a look at EPD, the one we first looked at. So if we go back to forecasting, and we go down, we can see that the analysts are really good at predicting EPD as well here. So we can pretty much take these analyst estimates. We can take these pretty good to the bank of what we're going to trade at. So if we go to 10-year normal PE for EPD, we're looking at about 15% year over year. Generally, when I'm trading, when I'm doing stock investing, I want to target getting around 15% to 20% year over year. I think that compensates me for the risk I'm taking by investing in individual equities. I think if I aim for higher than that, I could be exposing myself to too much risk, but again, making more money is always great. So with that being said, one of the companies that I've been asked to look at and that I'm interested in looking at is NRG, which is this is a utility company out of Texas. So let's take a look at our FAST graph here. If we look at the history of the share price, like we're looking at the historical view here, and we can see that the share price was long beaten down under earnings. This would have been a good time to be accumulating, but you would have been sitting flat for a long time. But eventually, if you're buying it, so if we scroll back and we look at 2019 or 2018, if you were buying this stock, you were buying this well above earnings. It was trading at a 26 PE, 27 PE if you were buying it near the peak, and the earnings weren't there to justify it. But then you wait. So this would not have been a good time to be buying it. But then, the earnings start going up. You buy it fully valued back in 2019, and you hold it all the way till today. You're looking at about a 20% year-over-year return. Now, while you're sitting there waiting during this flat period, you could probably be feeling like you got dead money. But eventually, earnings is what drives a stock to go up in the long run. In the short run, hype and momentum and traders and things of that nature. But you can't fake earnings in the long run. That's where the money comes from. So you could have been accumulating. It would always look good. But now you're saying, okay, that's historical. What about today? So today we see it's looking pretty close to fairly valued. It's trading right about a 15 PE. What does that mean in terms of what's our outlook going forward? So we go our forecasting tab. So analysts are predicting big time growth for NRG. So we got 16%, close to 17, 23%, 15%. So that's going to put us at a PE fair value at like 18. And if we bought it here at present day, we're looking at a 30%, 31% year over year. Now this is a utility company thinking they're going to grow this much. So let's take a look to see just how good the analysts are at predicting this stock. So if we look, the analysts are very good at predicting this stock. It's a 73% beat ratio with if we go 1 year with a 10% margin for error. I mean, we're beating and hitting a lot of the time 82% compared to missing at 18%. So and 2 years out with 20% margin, NRG is really good. The analysts seem to underestimate what NRG is capable of. So if we look here, we can also see how the analyst estimates have been changing. So 1 month ago versus the current, the estimates haven't really changed. But compared to 3 months ago versus the estimates are actually increasing. So that's a good sign. When the analysts keep moving their projections up compared to what they were 6 months ago, that's a good sign for the stock you're looking at. So say you're coming and you're looking at you come to Fast Graphs, you're like, this chart looks good. The analysts predict everything really well. What does this company even do? I don't even know anything other than a ticker symbol. So that's where we can go to external links here, and let's go to their corporate website. So here we can say, okay, we got that looks like a power plant in the back, and we can come to investors. And let's just check out a presentation. We can look at their earnings presentation. What do they do? So from here we can see that they're located in Texas. Smart home customer count, it seems to be, I mean, this still isn't telling us much of what they do. Peak load, that gives me a sense that it's electricity generation. We got data centers, electrification, and manufacturing driving electrical load growth. So there's a lot of tailwinds to electrical power. So this is I think the investors page and their earnings calls are a good source of there's a lot of information here. So this is one of the this is another. I like to spend my time really in-depth reading these to really understand what a company is about. If we come back to the investors page, we can find maybe the about page will tell us. So powers millions of homes and businesses across the United States and Canada. So power generation, natural gas, smart energy solutions. Fortune 500, 17,000 employees, 8 million customers, 25 gigawatts of power generation. So this is really what tells us what our company really is here. So NRG, I think, looks really promising at these levels, and it's electric utility, which is crazy to see that much growth from an electric utility. But Texas as a state, they have all the data centers, they have a lot of industry, so so NRG looking good. From here, I'm gonna go to here's another one I want to look at that I think is being really beaten down. Charter Communications. So scroll down here. I'm actually gonna remove the average PE because that'll change the graph. We see, okay, we track the historical price and we see that it got way overvalued back in 2021. PE of 37. That was, and then we have the bear market. Well, it crashed before the bear market. We see a large drawdown. So from there, see, we always get earnings are what drives share price in the long run. So we see that it finally caught up to crashed to perhaps where the earnings should be, and then it just kept crashing. So at this point, it's trading at a 3.78 PE. Now this is blended PE. So if you look up, it's Fast Graphs' way of mixing trailing 12 months of PE with the forward-looking PE. So if you look on a few different apps, you might get a different number for what they're looking at in terms of price to earnings ratio. So this is one of the stocks I've been looking at, and just based on this tool is, wow, the share price is cratered compared to the earnings. So we click here and we go back up here. I mean, it's predicting by 2027, the end of 2027, the share price being up to around $760. That's a huge gain from where it's currently trading at. So this is one of the examples where the share price has been way beaten down compared to the earnings. So if we go back to the forecasting tab, we have our black line is way below what it's forecasting, and if it just gets back to fair value, you're looking at 90% year over year. Even if it gets to trading at 10.5 price to earnings, you're looking at a 66% year over year. 7.5 PE, like, so the PE doubles. You're still looking at 46% year over year. That is crazy value. Let's see how good there's a lot of analysts following this one too. So like 20 analysts, 21, 15 for that many years out. Let's see how the analysts do. So it's more of a 50-50 with 0% margin. If we're talking 10% margin, they're still on track about 25 or 75% of the time, 73% of the time. And we're looking at more of 50-50 for the years out. So where the analysts are a little worse at predicting this company. So that's why I was looking at these other ratios. Like if we got as kind of if growth doesn't hit quite as what the analysts are expecting, or not pricing in the absolute best case. I mean, obviously the absolute best case is it jumps way back up past what the fair value is, and overcompensation rebound. For those of you who don't know, Charter is a large telecommunication company. So they own Spectrum Internet, which is, I mean, everybody's probably heard of Spectrum Internet at this point. They're nationwide. They're also starting to bundle in mobile customers for like cell phone service. The biggest part of the bull case for this is that they are at around a $20 billion market cap, and they are generating close to $10 billion in free cash flow, and they're just going to buy back stock. That's what the management team has said that they're going to do with all their free cash flow. And so what buying back stock does is it increases the earnings per share. So if we look at Charter, that's where most of this earnings per share numbers, the growth is coming from, is just them buying back their stock and reducing the share number on the earnings per share ratio. So because it has less to do, their revenue is actually pretty flat, and their margins are pretty flat, but because they're buying back shares, their earnings per share are going to go up a lot. So this would be an example of buy when there's fear, because we've fallen down, or I say we because I do have a position in Charter, but the stock is cratered, and so the black line is a lot lower than the fair value line. That's my thesis on it. We can take another look at another company that I've been asked about. And this is another example. What I want to look at is a company that I really want to own, but the valuation just doesn't look right to me. So if we look at Curtiss-Wright, now this might not be a very popular name that a lot of people know, but it has, as you can see, taken off here in the past few years, and it's just gone up non-stop. It seems like any quality company that exists in the past couple years is just, investors have just bid it up without any care in the world for what the multiple is. So I'll take you guys to what this company does, because this is actually, it's an industrial company that makes a lot of the nitty-gritty stuff in terms of like valves and pumps and motors and things of that nature. So they've been publicly traded for 95 years. So they're engineering and innovative products. So I work for a big-time engineering company, and Curtiss-Wright supplies a lot of our components for different pieces and parts in our manufacturing supply chain. So we buy a lot of stuff from them. So this is, they supply innovation and advanced engineering things. This is a company I would love to own if the value ever comes back. So this is one I watch, and I hope to get it. I would hope to be able to buy this, and this is something I like to tell people is, if people ask me, is I really like this company, but the stock is too expensive for me right now. It's had a great run, and I applaud everybody who invested prior to this run, because they've made a lot of money. So I hope that I get to get into this company eventually. But with this black line so far above the earnings line, yeah, that's a no for me. I can't do that. With that being said, that was an example of something I wanted to show. And we saw, like with Charter and NRG, is when these lines get way out of proportion, then they eventually do come back to meet the earnings. It might take a while. Another company in a similar vein is BWXT, which is a company I'd like to be in, because I'm really interested in the nuclear space. I think it's great. It's just everything has gotten so far ahead of its skis. It's even trading way above the normal market premium it gets placed. So BWXT is a big player in the nuclear space with they're doing some of the small modular reactor things. They do nuclear fuel services, which they supply fuel to the Navy for their reactors. They do some manufacturing for Canadian reactors. So they're another industrial type engineering type company, which that's a nice segue to talk about the next thing. Is if you know a sector really well, that's a good place for ideas. Like, my brother's really into fintech right now, so he sends me, he's like, check out SoFi, check out Oracle, check out O and Circle and things like that. Just because that's the sphere he knows, and I'm like, let's look at Curtiss-Wright and BWXT and a few industrials, just because that's the industry I know, and it's good to get a nice balance of perspective, different ideas. So I just like going through this and looking at different ideas. So here's a new company. So this is a drone company, and we all know that drones are all the rage with the Ukraine war, now Iran, and things of that nature. So I guess they aren't that new, never mind. But we can see that they've really taken off, and hype got behind them, and we see that they got way their share price got way ahead of their skis here, and we've come back down a lot since from their peaks, but we're still a lot very high above their earnings number. So if we go to forecasting, this looks a little bit better because we got really high growth rates expected in the future. So if we trade near these growth rates, like say it's expected to grow around 37, but we stay at like an elevated PE. So even if we came down to a PE of 37, which would be considered near fair value just due to the growth rate, we'd still be right near that 15% year-over-year mark, because even we're getting multiple compression, not expansion at this point. So this is another company I got my eye on, waiting for the right moment, trying to watch them a little longer because I haven't watched for that long. If we look at how well the analysts do, we see that the analysts have been really good with 1 year out, 2 years out, less good, but they definitely have the tailwinds of the drone headlines carrying them right now. So if we can go to their corporate website and check out some of what they're all about. So battle-proven defense systems trusted by our allied operators worldwide. Our all-domain dominance approach keeps customers ahead of evolving threats with 50,000 plus deployments in 55 countries. So here we got their land, so it's drone defense. This is their lasers that shoot down drones. We got sea, that we got a drone submarine. So here, I mean, this is a really cool company. You know, this is got the flash and the shiny new stuff. So that's why you see, when you see shiny new stuff, that's why you see this giant run up. That's typically from companies with flashy, shiny things. But in the end, earnings are what dominates everything. So this is another company that I'm watching. I don't own it yet. I've been watching it to see what the fair value is going to look like, just because it's starting to reverse from this really overhyped segment to now it's starting to come back to meet its typical where it trades. But that's another idea I had. Let me go into start sharing a tool that where I use to find some ideas. So I generally like to look at Finviz. This is one of the tools I use, and I use it to generate ideas. So we'll go onto the screener here. We can generally I'm trying to find, it depends on what I'm looking for at the time, but generally how I look for stocks is if my goal is to find a company that has solid predictable earnings, where if I'm trying to get to 15%, right, that's my goal. I can find something that has an earnings growth rate of 7% with a 4% dividend, then I know I'm at 11% off the bat if I'm getting that. That's somewhere in that ballpark, and and I know that that's a pretty well established company that's going to be able to deliver those kinds of, those are modest returns. Those are modest returns. But what I'm looking for is the companies that are doing that are just beaten up and kind of the market doesn't like them because they're not flashy kind of thing. So if I look at the mid caps, so I just set the market cap from 2 billion to 10 billion, I think it was. And then I just say we have a positive dividend yield. I didn't finish the thought how I get to from that 11% to the 15 to 20% I'm looking for. So if they're beaten up, disregarded by the market, and they're trading at a really compressed multiple, you start to see explosive returns when you invest in those, and then they don't, and then you get margin or multiple expansion on the companies, and that's where the real returns start get driven by. So I got dividend yield. I really only like to look at U.S. companies. Then I look at, I can look at their fundamentals. This tab here, I want to look at their forward PE. Look at under 15. And then I want to look at earnings. I want to look for one where the analysts are predicting earnings to grow like over 5%. So we actually got 9 pages of companies here, so 164 total. And then when I'm looking at these, I generally don't want to pick asset management. I don't like to look at REITs. I don't want to look at anything along those lines, just because they don't really trade. They trade with different metrics, not just earnings, because banks they trade on like leverage ratios and loan returns and things like that, which all should come back to earnings, but it's just not how I'm looking I'm not looking for banks and asset management right now. So like we got ACOM. I just try to, first thing I see, okay, ACOM, that's engineering and construction. It's not asset management or something along those lines. So I'm just gonna come and I'm gonna type in ACM. Let's check out what the heck's going on. See if the chart looks somewhat decent. So this is something that, oh, look at it. The share price got out ahead of its skis, but now it's fallen to where it might be undervalued. So I'll check out forecasting. See, okay, we got modest growth coming. It's got a dividend yield almost 2%, and their analysts are okay at predicting what they do, and ACOM's pretty good at beating it. So we can look at this and think, oh, this is a decent stock. So if I invest right now, I think I could get around 23% if it gets back to fair value. If it doesn't get back to fair value and it just keeps trading at, it just trades at what it's currently trading at, I get about 13%, which is pretty right in line with, I mean, it's a little bit below my goal, but that's kind of, I'm looking at the multiple doesn't get back to what it's to a 15 PE, which it's traditionally traded at a higher than 15 PE. I don't exactly know what ACOM does, so this one might be a good time to go look at it. It said engineering construction, so it should be up in my wheelhouse, but sometimes that Finviz stuff isn't the most specific. So we got energy transition, the dome, social infrastructure. So they are the construction company that does these things. Well, they're probably gonna see a lot of if they're construction, they're probably gonna see there's a lot of construction we need to do here in the United States to fix our infrastructure. So whatever. We believe infrastructure creates opportunities for everyone. Now this is some frou-frou language about uplifting communities and sustaining our planet. So maybe they're getting hit with maybe they've overextended themselves in some green projects, like we saw the windmills off the coast and things of that nature. And maybe they're seeing some bad headlines, and that's what's driving the price to get beaten down right now. But overall, from here, this is where I would put AECOM on the watch list, and I would do some more digging. And I'd probably read their investors report and things like that. So if we go back to Finviz, so AECOM, it's on my list to look at. So I'm not that interested in insurance. Well, let's check out ABM, because I don't know what specialty business services are. If anybody knows what specialty business services are, let me know. This looks like another one. So it's got a nice growth chart. It's not as exponential, smooth growth as you'd like to see, but it's going up. It's got the right direction. It's not too choppy. You can see it got really beat down for some reason. But it looks like it's starting to revert to the mean. If we forecast, if it comes back to a 15 PE, we're looking at about a 20% year over year. So this is another one. I have no idea what they do, but look, we got 16% growth, 8% growth, close to 5%. They're paying a 2.5% dividend. This is the kind of company I would look at. And the analysts are we can take these numbers to be pretty locked in from these 8 analysts if we look at our pie charts here. So they seem to be. This is another one. Okay, what do they actually do? Whatever specialty business services do. Okay. Solutions. Who are we? Transforming spaces and places. What does that mean? This might be a time where I should use ChatGPT to tell me what all these companies do. How do we transform spaces and places? Engaged in technologically enabled teams focus on your success. Become part of your team, respecting so they're like consultants. They sound like consultants. I don't know if that's the kind of industry I don't know about that one, but the financials look interesting. I'm not. I'll put it on the list. I'm not super sold yet. You got American Eagle, not something I want to be involved in. ADT, we've seen their signs out front. I don't know, not really that interested. I guess I should make sure it's not. Maybe I'm missing something. Maybe they're just so beaten down and everybody thinks that, so therefore they don't get any investment. Well, this chart's really ugly. So they had like no earnings, and they had a lot, and they had none, and now they're kind of flattening out. And meanwhile, the market doesn't normally give them any kind of multiple, because, I mean, just look at this graph. How could you value a company like? Do they make money? Do they not make money? I don't really know. It seems like they've got it figured out and seem a little bit more stable now. If you were to invest in, I mean, this might be one of those, it's beaten down and the market hates it, but the analysts also aren't that good at predicting it. Could be interesting, might not be that interesting. Agco is something I've had on my list for a while, but they're pretty cyclical. They do really heavy farm equipment like tractors and things of that nature, but they're very cyclical. Like it looks like we're coming out of a cycle here. We're back to historical. So boom, bust, really big boom, bust, and now we could be on the precipice of another big boom. The big booms are always bigger than the last time, it looks like, so that's what you'd be betting on here. And it looks like people are trying to front run that we're trading at a premium. So if we look at forecasting, so yeah, it's predicting some big booms here in the future, 32%, 22%. And the analysts are pretty good within 1 year. So in 1 year we got 13% and potentially 32%. I mean, we could be trading, if we just traded at like a 15 multiple. Okay, if we traded at a 15 multiple, we're only getting like 11%. So you're really expecting the multiple to expand here. Is where a lot of that forecasted growth is. If we see that the blue line doesn't really move off the orange line, so that's not that exciting. Auto parts, I'm not that interested in auto parts. Asset management, whatever, thermal coal. This is another limited partnership. So I already own a limited partnership, so I'm not that interested, but I'll just look for looking's sake. They generally have a big dividend, and you have to do a Form K. Yeah, look at that cyclical nature. Okay. That's not the kind of stock I like to see. I generally like to see a nice smooth up into the right curve and just find something that the price hasn't caught up with the curve kind of thing. Especially chemicals. So Academy Sports and Outdoor brand is, so one of my favorite podcasts. One of my favorite podcasts is sponsored by Academy, so that's where I first heard of them. They're not that old of a company, and now I finally moved somewhere close that actually has some academies. They're a brick and mortar competing directly with Dick's Sporting Goods and things like that. So you'd be, if you're not looking to own a brick and mortar store, then like a Dick's Sporting Good, then this really isn't your company. So there's a 12%. Because it's not going to get to 15 as we see in the historic. I mean, maybe if they get more of a track record, but I don't think brick and mortar is going to get that kind of value just with the e-commerce taking all the market share. Let's see. I just wanted to show that because I really like it's Josh Pate's college football show sponsored by Academy. So that's gold. That'd be an interesting one to look at. I'm not sure. This would be one of those companies where it's like, oh, their graphs might look really well, but they trade based on the price of gold, and it's, wow. So we're expecting a huge boom in the future. So they had like nothing, then something, and now, who are these people? They're mineral. So I mean, of course the analysts can't predict. Like, this is a mining company. I don't know. This has me really intrigued because something is predicting something that they're about to take off, and 327%. I mean, that's skewing these multiples because of this number. So let's just, even if it traded at a 10 PE, we'd still looking at a 40% year over year, which I have no idea. It'd be really interesting to look into where is this expectation coming from? Because that's really insane. So I'm just add that to my portfolio, my watch list. I realized I didn't do that for the other companies I was looking to watch. Oops, that's my options trading project that I'm working on with ChatGPT. There's a lot of companies here like that we could be looking at. I just wanted one more. I think I want to talk about banks, lumber. Let's see. One thing I want to talk about is the software collapse that's happened due to AI or whatever people want to say. So like one of the biggest people have taken a hit is Adobe, and so as you see, this is one of those, dang, look at how high the price got, and look at the premium that they were putting on. Then 2022 bear market, it comes back down, and it comes back down, gets close to the fair value line, but and then it rockets back up. Now it's coming all the way. Now it's really beat up, really out of favor. But there's a lot of negative press around software and AI because AI could transform it, could really reduce the price. A little anecdote is my work has recently switched from Adobe to Tungsten Power PDF. So I've never even knew that there was competitors to Adobe in the PDF space. So that's kind of an anecdote that makes me pause looking at this graph just because it would. The analysts really have no way of predicting what's going to happen here due to AI. This would be a nice value play if you're like, Adobe's not going anywhere. They'll be able to maintain their pricing power. Nobody's really going to switch from Adobe to their own homemade vibe coded PDF app. Yeah. So that's an interesting one. I clicked on Finviz. Yeah, so I think with like a lot of these specialty chemicals or just chemicals, you see they're really big. They're really cyclical. You'll see big spikes and big crashes and big spikes and big crashes. So that's interesting to look at. So like what made me thought of the software was I saw this box. I don't know, is this Square? Is this Jack Dorsey or whatever is new? Is that what they are? It still doesn't look that great. Me personally, I wouldn't invest in any payment processors other than MasterCard and Visa just because there's so many competitors and there's so much, it's always changing, and Apple's going to eat a lot of the, Apple and Apple Pay ate a lot of the market share. So so that's my process really. Let's see. Well, one company I've been meaning to research, let me close these tabs because I have so many open. But one of the companies I've been meaning to research because my dad asked me about it was, I just haven't had time. So this is a really new company, and I had a second to look at it. So where he got this idea, this is a Honeywell spinoff, and he got this idea from it somehow being a nuclear play. So, I mean, the graph looks terrible right now. This doesn't look too bad, but they're expecting 80. I mean, it gets skewed because it's 81% right here. So they were talking about this is a material science company with they do something with uranium, part of the uranium fuel cycle process, which I am not so sure. I mean, I'm in the nuclear space and I've never heard of these people, so ballistic fibers, material science innovation. Yeah, I'm not sure how the YouTube short or Facebook reel that my dad saw said something about them being they convert uranium, which I don't know what they're talking about. So I mean, I guess this would be it. Nuclear energy services. But this is not, they're not exactly. Okay, so they supply uranium hexafluoride, which is what you need to convert uranium to enrich it. But this doesn't look like it's even a main part of their business because it was not the first thing listed. So I guess it technically is a nuclear play. However, the earnings aren't reflecting that yet. So not as interested. What's the other one? ATMT. No, that's not it. AMTM. That's the one. This is another company my dad asked me to research. They're fairly new. Their graph looks more intriguing than the last one we looked at, but still less than intriguing. Just because it's hard to like 9%, 12%, 13%. I mean, that's modest. No dividend. There's not really a history for the analysts to have. They do have 9 analysts following it, or 11 currently, and 9 and put numbers up for the future. So I mean, if it gets traded at a full fair value up to 15, you're basically hoping to get to the return goals because you get multiple expansion, not really because you're going to get a massive blowout in earnings. So if you go down to, I mean, if you trade at, if earnings go the way everyone thinks it's going to go and it trades at a 10.5 PE, you get to, how low can we go to really keep our goal? So 9 PE, that's 9%, that's not enough. So really we need these earnings to happen and we need it to trade at like a 10.5 is pretty much where we're at with it. There's not really, I don't even know what they do, so because that's a big part of knowing are they going to be able to achieve that stable growth. So we got more shiny stuff. Okay, so design support contract for the tritium finishing facility. That's interesting. I just know that site and industry. So if they're getting Savannah River contracts, it's probably not that crazy that they can pull off 13% growth. Our capabilities. What do you do? Delivering solutions. I hate when companies like, it's so vague. What is delivering solutions? Life cycle solution. What does solutions mean? Like, what do you buy and sell? Full life cycle. provider and integrator. Okay. So just based on the industry they're in and what kind of contracts they're getting, they definitely seem like they can keep up these projected growth rates. And I think you could probably even get multiple expansion because they got all the shiny stuff going on and they're in the hot new defense industry and space and all that. So you might even see them catch some helium and hype and things like that. So that was another company that my dad wanted me to look into. I think this one, there was one more that he wanted me to look into. I'll look at it today. This was another one. So as we can see, Centrus Energy, I don't actually own this one, but from this graph, we look like we've been diluted a bunch at this point, if we try to forecast it. So what this company does is they have contracts right now to make the centrifuges for enriching uranium to make nuclear fuel. So, yeah, you're basically hoping that they get massive contracts and massive sales going forward. You're hoping for this 2028 number. To me, they're gonna have to prove it some more. They're at too high a valuation to be diluting and burning that much cash. If you see a graph like that, that means the shareholders have been diluted a bunch. So, yeah, Centrus Energy, they have to prove it a little bit more to me they gotta prove it a little bit more for me to buy buy what they're selling. So they're saying they're gonna get, what this company's saying is they're gonna get supply. I forget what NNSA site is getting all the. I'm not even sure it's an NNSA site, but a DOE site's gonna get a bunch of centrifuges from Centrus. They're gonna be supplying them NQA1 quality, which is the nuclear quality standard, which is a pain in the butt to meet. So they actually just got a massive, well, they did get a contract in there in the area I live in. I saw someone on LinkedIn was a while ago was like, hey, are you interested in Centrus? And I was like, I like my job presently, but yeah, so that was one my dad's asked me to look at. It's kind of funny to me when people you see random people on YouTube are like, the nuclear industry, it's going to be huge, it's growing so fast. But then people that work in nuclear know nothing in nuclear grows fast. It's nuclear. It's like trying to do a U-turn in an aircraft carrier. It takes a while. So with that, I think I'm going to wrap up the stream here and get ready. I'd like to talk to you all again next week. I'll post this on my YouTube channel. I'll probably clip up some videos. Remember, like, comment, subscribe. Come check us out. Come check me out again. If you like how I'm going through these stocks, if you have stock ideas, leave them in the comments. I'd love to interact and hang out more.